Hey everyone, hope everyone is doing well and has had a good day so far. A couple things I want to talk about. Daily chart, spike and channel, bull trend. We formed a trading range and we've sold off. This is a strong enough sell off that the odds were we were going to bounce around 5,000. It was around a 20% correction, 15, I believe it was 20%, maybe a little more. And 5,000 is such an important round number. I think April the 9th, this bull bar is important. And it's important because it's either a trading range bar, it's a strong enough bar that it increases the odds that there's buyers at or below the bar. And you can see this bar was a large bar. Well, let me back up. It's the reason I say it's a strong enough bar that it's going to make that it's more likely to be a trading range or lead to a rally. And when you get a climactic bar such as this bull bar, April the 9th, when you get a bar that's that big, it often acts as a trading range bar. And what that means is there's typically buyers around the middle to bottom third of the bar and sellers around the upper third of the bar. And therefore, when this bar closes, this bar is climactic and it increased the chances of a gap down or a sell-off on the next day. But the odds were there were probably going to be buyers scaling in lower. And you can see it sold off, found buyers around the midpoint, rallied to the close. But you had buy the close bulls here, disappointed by the pullback, getting out break even. And then the bears managed to get a couple of legs sideways to down. And now we're over here. Strong enough a bull bar, odds favor some kind of second leg. Bulls are hopeful for, at a minimum, they want this. They want to rally, pull back, second leg up, which takes you back to around the midpoint of this trading range over here. Right now, we have consecutive bull bars today and last Friday and Thursday. We have a weak bear bar today, but it's not a strong enough reversal, and that increases the chances that there's probably buyers below, even if the market has to pull back for a couple of legs first. 60-minute chart. I mentioned in the trading room last week that I thought the market was probably going to have to touch the 60-minute moving average. We tried to touch it here after a gap up and then another gap up, testing the top of the trading range here. And we finally touched it last week. Or actually, we finally touched it today. Big down, big up, big confusion, probably going to start to go sideways. But what do you notice about this? We're forming a lot of bars above the moving average, and that's a sign of good buying for the bulls. On the 5-minute chart, make this a little bit smaller. Just fix one thing here. 5-minute chart. Today, gapped up, forming a very small gap. And we rallied and sold off on the open. And actually make this a little bit. That's better. Trying to add more bars to the chart. Anyways, bar one, reversal bar, but 20% chance it's the low of the day. small body relative to the tail. So probably more traders buying below than selling. 2, not a good reversal for the bulls, not a good buy above, but it's certainly not a good entry bar for the bears. And that increases the chances that those traders buying willing to scale in lower. 3, a little bit of a surprise, strong enough bar, probably going to go at least a little bit higher. But what do you notice? We've been in a bull channel for quite some time, and we're basically getting a bull breakout of the bull channel. So, in other words, you're breaking out. And when you look at this, it's just one bull bar, and we've had 2 dojis on the open. So, is there a rush to buy the close at 3? Not really. At a minimum, traders can wait for the follow through. If since 3 closed on its high, what do you do if 4 is another bull bar closing on its high? Well, then it'll be higher probability that the market is probably going to go. It'll be higher probability of a second leg. 4, doji, bear bar, but an implied second leg up with 1 and 4, tail below 4, so probably buyers below, but really not an ideal bar for the bulls. You'll have some traders buying below, but it's really not ideal. We're getting consecutive buy climaxes, and it might be 3 legs up. Friday's bar 77, today's bar 1, today's bar 4. And therefore, there's probably buyers below 4, but there might be sellers above 5. And instead, 5 is a bear bar closing on its low. Strong enough surprise, probably going to go at least a little bit lower. And therefore, the first reversal up will probably be minor. 6, another bear bar, good for the bears. We have consecutive bear bars closing below their midpoints near their lows in a 3-bar bear micro channel. But what do you notice about 6 and about bar 4? Well, 4 was a reasonable buy below the bar. It wasn't a great buy, but it wasn't all that terrible of a buy either. And now, and because of that, that increases the chances that there's bulls trapped who bought the low of 4 scaling in lower. So what does that make you think about the potential for reversal up on 7 or 8? The reversal up is reasonable. We have a breakout test in a trading range. We have a breakout point in a trading range. And most of the times when you get a breakout point in a trading range, usually it gets tested. And therefore, selling the close of bar 6 is a little bit risky. By the way, if you hear me yawning, or if you hear me not talking for a second, sometimes around this hour, I tend to get tired. And when I start talking, I can't help it. And I start yawning at times. So I apologize. 7, reversal up, bull bar, closing on its high. Strong enough bar, second leg up likely. So we have 2 things. We have the sell off to 6, which is likely to get a second leg down. And now we have the rally on 7, which is likely to get a second leg up. What does that create? That creates a minor reversal up that's likely to get a second leg. I just realized. Make the chart look better. We have a minor reversal up 7 that's likely to get a second leg. And we have a strong reversal down that's likely to get a second leg. And because of that, it increases the chances that whatever reversal down we get on 8, we'll find buyers below. 8, a doji, not a good buy below, not a good entry bar for the bulls buying above 7, but not a good sell below for the bears on 8, and therefore buyers below 8, probably buyers on the close of 8. 9, an inside bar, probably buyers below 9, buyers below 8, willing to scale in lower. 10, bull bar, that might be the minimum for a second leg up after 7. And because of that, there might be sellers above 9, sellers above 10, scaling in higher. 11, surprise, good for the bulls. What about buying the close of 11, betting on a reversal up and test of the 4 high? I would not. 11 is just 1 bar, and it's got a tail below the bar, so it's a bull break out of the tight trading range, 8, 9, and 10, and it's a possible second leg up after 7. And because of that, there's added risk that there might be more traders selling up here rather than buying. 12, reversal down, good for the bears, probably going to go at least a little bit lower. An implied second entry after 8, and therefore always in bulls if they bought above 7. Unfortunately, they probably get out above below 12. Even if 12 is not a bear bar, and let's say it's a bull reversal bar, unless it's a strong bull reversal bar, it's probably going to have sellers above on 13. In 13, bear bar testing near the low of 7, bad follow through 13, closing above the midpoint, but not a good bull bar to buy, and therefore there's probably sellers above 13 scaling and higher. What about the bulls who bought the close of 11 and bought more lower in the bottom third of the 7 low? Reality is they'll probably make money or at a minimum avoid a loss. 14 bull bar, possible lower high after 12 and 13, approaching the sell zone of bar 11 by the closed bulls. Some bulls bought the 11 low, making a mistake, scaling in lower, trying to get out break even. And you can see traders who sold during 13 disappointed with 14, the bull bar. They sold, tried to scale in higher, and then got out near the bottom of the bar. '16 bull bar breaking out above 15, but approaching the area that I mentioned, the close of 11, and that increases the chances that there might be more traders selling up here rather than buying. And then 17 bear bar reversal, possible double top with 11 and 16. Not a good entry bar below 16, but this is a trading range. Whenever you have a trading ranges are filled with bad stop orders, and that end up working. Bull bar, well, let me restate that. Trading ranges often form bad stop entries, bull bars that lead to reversals down, bear bars that lead to, there's not any good examples of bear bars that lead to strong reversals up. We had the sell off down to 7, and it's a strong enough breakout. It's a strong enough bear breakout that the odds are it's going to get a second leg. And a lot of times in a trading range, second legs are delayed, and therefore you get the bear breakout, price goes sideways for a lot of bars, and then it gets a second leg down. That is very, very common. 17, 18, trying to get a bear breakout of the triangle. Triangle is this contracting range right here. Strong enough breakout, 17 and 18. I suspect the first reversal up will probably be minor, and we'll get a second leg. 19, reversal up, but a close below the midpoint. It's a breakout pullback sell, probably going to go a little bit lower. And then 20, a bear breakout closing below the tight trading range. Strong enough bear breakout that the market is probably strong enough bear breakout that I suspect there's sellers on the close, sellers above, and will probably go at least a little bit lower. 21, bull bar, possible failed breakout of the tight trading range, but realistically, not a good buy above 21. And 20 was a surprise, and therefore you have trapped bulls. You have bulls who bought below 19, bulls who bought below 18, scaling in lower during 20, and now they're trapped on 21. And that increases the chances that there might be more traders selling above 21. '21 bull bar, tail above the bar, probably sellers above. And then 22 bear bar closing on its low, good for the bears, probably going at least a little bit lower. 23, another strong bear bar. Do you sell the close of 23, 22, another strong bear bar. Do you sell the close of 22? You can, but you're in a channel. And typically, when you get bear bars closing on their lows in bear channels, usually it's better to wait for the reversal attempt and then fade the reversal. Don't sell the close. Wait for some sort of bull bar or reversal attempt. 24, another bear bar. It's probably strong enough that we'll probably go at least a little bit lower. And then we have a reversal up 25. Not a good bar for the bears, and therefore sellers above, sellers on the close, scaling in higher. Outside up 26. Good for the bulls, but right now, buying the close of 26, it's buying two legs up. The low of 24 rallied to 25, pulled back to the 26 low, and rallied on 26. What about selling the high of the bar? I don't know if you have to sell the high of the bar, but even if a bull's willing to sell and scale in, they're probably going to make money. And 27, bear bar closing on its low. Good for the bears. Probably going to go at least a little bit lower. 28, follow through. Not a great follow through bar, but it is minimum follow through. And 28 is a bad stop entry buy above. 29, bull breakout, but closed below the midpoint, testing the upper third of the bar 27, the sell signal bar. Looks like we're probably going to go a little bit lower. 30, bear bar, looks like a doji, forming a tight trading range after this bear breakout, but the odds are we're probably going to get trend resumption down. 31, bear bar, closing on its low. Good for the bears. Probably going to go at least a little bit lower. 32, follow through for the bears, but a body smaller than 31 and tail below the bar. Probably going to pull back within a few bars. And then 33, another bar, smaller body than compared to 32. And 32 is smaller than 31. So it looks like we'll probably bounce. What about the bulls who bought the 30 low and more lower? I suspect those bulls are probably going to make money. And because of that, I suspect we're probably going to get a bounce. Bull bar 34, good for the bulls, but after a 4 bar or 5 bar bear micro channel, probably sellers above and at least a second leg down. One moment. Probably sellers above, but consecutive sell climaxes and will probably touch the moving average soon. 35, bear bar, but closed above the midpoint, probably sellers above and going to get a second leg down. 36, another bear bar, closed at the midpoint, and a new low below 33, and therefore that met the minimum for a second leg. Bull bar 37 looks like we're trying to bottom out near the moving average, and therefore we're probably going to find buyers not far below. 38 consecutive bull bars, tail 37, tail 38, probably going to start to go sideways. 39, another bull bar. So now we're starting to get consecutive micro channels in the opposite direction. So micro channels for the bulls, but tail 37, tail 38, tail 39, really close to the moving average. As far as buying it, I think it's probably better to wait for the market to stabilize. 40, bull bar, closing on its high. Good for the bulls. A bull breakout of the bear flag. And therefore, bulls are hopeful that this is the start of a test up to the top of the channel that began at 27. But realistically, bulls probably better off waiting for follow through. Why are the bulls better off waiting for follow through? Because of bars like 41. 41, bear bar, closing on its low, and therefore a reversal down. Strong enough bar on 41 that will probably get at least a small second leg. But what about the bulls buying down here and scaling in lower? Realistically, if you're buying here, you probably need to buy more at the 36 low. And unless you can use a wide stop, maybe based on this range, it's probably not worth doing. 42, reversal down to the bottom third of 36, but finding buyers. That makes me think that we'll probably test back up to the 40 close sometime soon. Buy the close bulls, they buy the 40 close, even though it's at the moving average, not ideal. They scale in lower, betting that they can get out break even. 43, sellers above 42, and a pullback. So a breakout pullback sell, a low one below 43, but not a good doji, not a good bear bar to sell below since it's a doji. Probably buyers below, scaling in lower. And then 44, bear bar closing on its low. Good for the bears, but probably buyers at or below the 36 low. And then 45, we have another bear bar closing on its low. Good for the bears, but 2 legs down late in a channel right at support, the 60-minute moving average. And best looking bear bar in the overall picture or sell off from here. that's probably going to lead to bad follow through and buyers below. And you can see reversal up 46, good for the bulls. 2 legs down from the 40 high, probably always in bears, get out above 46. Too much risk that bulls will buy above it. 47, bad follow through for the bulls and a low one short for the bears, but a tail below the bar. Sell the close bears 45, probably disappointed 46, and therefore I suspect there's probably buyers below. And then 48, outside down, good for the bears, but probably not gonna go that much lower before we get a bounce. 49, bull bar, always in bears, probably get out above 49, too much risk bulls will buy. And then 50, consecutive bull bars, 49, 50, looks like we're starting to stabilize. 51, 3 consecutive bull bars, open gap, 49 high, 50 low, probably traders buying, willing to scale in. 52, another bull bar, probably going to get the reversal up here. And then 53, another bull bar. 5 consecutive bull bars closing at or above their midpoints, all with trending highs and trending closes, meaning at every high is at or above the high of the prior bar, and every close is at or above the close of the prior bar. That's a sign of strong buying. 54, another bull bar, good for the bulls, but a climactic bar compared to 53 and 52, so probably going to pull back. 55, doji, probably buyers below, scaling and lower. And you can see we went sideways for several bars, and then we bounced up on 59 and 60. 60, second leg up after 56, and that's good for the bulls. Probably going to go at least a little bit higher, still always in long, and the channel up is tight. Always in bulls, what do? Always in bulls can get out below any bear bar, but overall, there's no reason for the bulls to get out yet. Bear bar closing on its low 61, okay to exit, but just look at the rally. If you see a bar like 61 closing on its low, what's the expectation? The expectation is it's probably going to have bad follow through. 61 alone is a strong enough bar that it may get a small second leg, but even if it does, it's probably going to be delayed. In other words, it'll probably be something minor. So a bear bar 61, bad follow through 62, and maybe a second leg down 63, and then a reversal up. And instead, we got a bull bar on 62. 62, strong enough reversal, probably going to get at least a second leg up. And we got bad follow through 63. You have disappointed bears 61 and disappointed bears on 61 who sold disappointed 62, and some of those bears trying to get out break even at the 61 close. And you can see the market is not letting them out break even. And then the market reversed up on 67. 67, strong enough bar, probably going to go at least a little bit higher, but certainly nothing wrong with waiting for the follow through or even waiting for the reversal attempt. And then going higher. Just 1 second here. Follow through 67, 68, good for the bulls, probably going at least a little bit higher. And you can see we basically rallied back up to the moving average, and we basically are forming a small pullback bull trend. When you get a small pullback bull trend like this, usually it's better to wait for more signs of selling pressure before you're looking to buy. And then you can see we had kind of a blow off top and then a reversal down. So what happened here? Well, for one, this is a good example of two things. One, when you look at the higher time frames, you have a bull bar on last Friday, and therefore the bottom third of that bar is going to be a support range. And therefore, when the market starts to sell off testing near the bottom third of the bar, it's likely to find buyers. And because of that, when you see a trading range open and then a bear breakout, 20 bull bar, bear breakout sideways, that increases the chances that you're going to find a lot of buying pressure. It increases the chances that you're going to get some kind of reversal up, and it's unsustainable selling. For stop entries, I thought it was okay to sell below 5, but not all that clear. And then buying above 7 is okay, but it's probably minor, so it's really not ideal. You can sell below 12, betting that it's 2 legs up and that the sell-off to set to the 6 close is likely to get a second leg down. You can sell below 17, sell below 19, or wait for the bear breakout 20. Either of those are fine. If you don't sell 20, wait for the reversal up, attempt 21, and then sell below 22. That's okay as well. And then overall, I thought it was always in short. And then if traders exit above 26, they probably sell again below 27 or below any bear bar. You can sell below 27 or the bear breakout below 30, the 24 low. Any of those are fine. And then bears, they probably get out below one of these bars. It makes sense because it's in a channel. But if you do, you sell again below 41. And then for the bears, if they sell 41, they probably get out above 46. And if they do get out above 46, I would not sell again below these bars. And then bulls, some buy above 46. If they get stopped out below the 46 level, they buy again 47. Other bulls buy and use a wide stop and hold their position and add on as the market starts to go up. Bulls, they can buy 48. And where do they get out? Really not any good area. Some might get out below 61, but realistically, probably buyers below. And if they do get out below 61, they buy again above any of these bull bars. And then obviously, it's smart to get out when you see 60, 77, especially when you start to see 78 reverse down. Limit orders, I thought buyers below 1, sellers above 1, sellers above 2. I thought buyers below 4, but the buyers may not come in until at the low of the day or lower. And then when you see this off to 6, I thought there were probably limit orders selling the breakout point, the 4 low during 11. I thought probably buyers somewhere in the bottom third of this bar. And then overall, I thought sellers above 18, sellers above both buyers below 25 and sellers above 25. I thought sellers above 28. And I thought buyers below 34, 35 for a bounce, sellers above 42, and then buyers below 47 or 48 for a second leg up, buyers below 56, 57. And then I thought probably buyers below 72, 73 for a bounce. And then buy the close, sell the close. The first realistic buy the close, sell the close was probably maybe 20, sell the close 20. Better to wait for follow through, and therefore you can sell 20, but if you do, it's probably better to sell a pullback. You can sell the close of any of these bars, but same thing. Probably if you're doing that, you've got to be willing to hold through the pullback. And then as far as buy the close, was this sell the close? I don't think it was really sell the close. I think it was too much of a trading range, too much of a channel, and therefore channels evolve into trading ranges. And then I thought buy the close all through here for a second leg up, buy the close 67, buy the close 68 for a bounce, even buy the close 71. But when you look at that, do you really want to buy the close of this? Probably not. Consecutive buy climaxes, and that's probably more of a profit taking bar didn't buy the close bar. Let me take a look at a couple of questions. Well, first, where do we go tomorrow? I think we have a bad stop order sell, and therefore probably buyers below, and that increases the chances that we'll bounce to 5,600. So overall, even if we pull back below this bar, it's not a good sell, and therefore there's probably buyers below scaling in lower, but not strong momentum for the bulls either. All right, question. Can you explain 60% probability break even, please? Because I don't think bar 16 was a reasonable buy at the top of a trading range. Oh, okay. Yeah. So basically, can you explain? So let me back up. I believe when I talked about break even here, what I said was buying the close of bar 11. You'll have traders buying the close of 11, scaling in lower, looking to get out near break even somewhere up here. As far as buying 15, 15 is really not all that great of a buy. It's two legs up, and you already have an area of resistance, and the sell off down to 6 was strong enough for a second leg. Okay, it was 46 and is 46 and 49 considered a double bottom? Yes. You can call it a double bottom, you can call it a lower low. It's basically the exact same logic. All right, so that's all the time I have. Appreciate everyone for listening, and I hope everyone has a great evening or morning wherever you guys are.